All right, picture this. You're the head of risk at a huge global bank. We're talking trillions of dollars flying around every single day. How on earth do you even begin to wrap your head around all that? Well, today we're going to talk about a single number that tried to do exactly that. A little something called value at risk.
So let's just jump right in with a question that probably gives CEOs nightmares. It's not a trick question either. It's actually terrifyingly simple. How much money could your entire company, every single desk, every single trade, lose by this time tomorrow?
And you know what? This wasn't some thought experiment. This was a real demand from the chairman of JPMorgan back in the late 80s. He was just done with getting these giant 100-page reports he couldn't make heads or tails of. He wanted one number, just one. That's it.
And so that demand created what everyone started calling the 415 report. Why? Well, because a single piece of paper with that one number landed on his desk at 4:15 p.m. sharp every single day right after the markets closed. This was basically the birthplace of value at risk.
Yeah, so the whole point here, the big idea, was just radical simplification. I mean, think about it. How do you take thousands of different stocks, bonds, currencies, all moving 1,000,000 miles an hour, and boil it all down to a single digestible number that an executive can actually use to make a real decision? That was the puzzle.
And the answer they came up with? It was basically a new way of talking about risk, a new language, really. And they called it value at risk, or VaR for short.
So what is it really? At its heart, VaR is a statistical tool. It's not just a wild guess or a gut feeling. Nope. It's a calculated number that tries to put a hard figure on how much you could lose over a specific amount of time.
And the way it works is actually pretty elegant. You can boil every VaR statement down to a single sentence. It always has three key ingredients: a confidence level, like 99%, a potential loss amount, in dollars, and a time frame, like the next day or the next 10 days. You mess with any one of those three variables, and the whole risk picture changes.
Okay, let's make this real. Here's a classic example regulators use. A bank might say, our 10-day 99% VaR is $20 million. So what are they actually saying? They're saying they are 99% sure they won't lose more than $20 million over the next 10 days. But, and this is a huge but, there's still that 1% chance that they do.
Right. So how in the world do the quants, the math wizards, actually come up with this so-called magic number? Well, it turns out there are a couple of main ways to get there, and each one has its own logic. Okay, the first method is called historical simulation, and it's probably the one that makes the most sense right off the bat. You basically just look back in time. You grab, say, the last 500 days of market data. Then you run your current portfolio through each of those 500 past days, creating 500 different what-if scenarios. You rank all the outcomes from best to worst, and if you want a 99% VaR, you just look at the fifth worst day. The whole idea is simple, right? The future is probably going to look something like the recent past.
And this really gets at the two different philosophies behind calculating VaR. The historical method, like we just saw, is all about what's actually happened. It doesn't make a lot of assumptions. But then you have the model-building approach. This one's more, well, mathematical. It assumes markets behave in a certain way, like a classic bell curve, and it calculates risk based on stuff like volatility. It's a bit more elegant, and it's often way easier to use for massive, complex portfolios.
Okay, but here's where the story takes a turn. For all its brilliance and simplicity, VaR has a huge, dangerous blind spot. It tells you a really important part of the story, but it leaves out the scariest chapter.
Here's an analogy for you. Imagine VaR tells you there's a 1% chance of walking off a cliff. Super useful information, right? You definitely want to know that. But here's the question. What does it not tell you? It doesn't tell you if you're falling 10 feet or 10,000 feet.
And that's exactly why this is so critical. Let's go back to our $20 million VaR. The second your losses hit $20 million and $1, VaR just goes silent. It's done its job. To the VaR model, a $25 million loss and a completely catastrophic, company-ending $100 million loss look exactly the same. They're both just part of that 1% tail event. And that, right there, is the fatal flaw of VaR. So, realizing this massive flaw, the really smart risk managers started asking the obvious next question. And that question led them to develop a much better, much more complete metric. And that metric is called expected shortfall. What it does is answer the one question VaR completely ignores. Okay, so the bad thing happened. We fell into that 1% tail. Now what?
Expected shortfall actually calculates the average loss you can expect once you've already crossed that VaR threshold.
So when you boil it all down, it's about the question you're asking. VAR asks, what's the worst that's likely to happen? Or where's the line we probably won't cross? But expected shortfall asks a much scarier and much more useful question. If things get bad, what's our average loss going to be? See the difference? One sets a boundary, the other prepares you for what's on the other side.
And this all kind of brings us to the bigger picture here, right? The whole philosophy that sits behind all this math and all these models.
Because at the end of the day, it's not just about spitting out a number. It's about really truly understanding what that number is telling you. And, maybe more importantly, what it isn't telling you. That's the real difference between just gambling and being a proper quantitative analyst, knowing the limits of your own tools.
Which kind of leaves us with one last question to chew on. Whether you're in finance or really in any part of life, are you just focused on the odds of something bad happening, or are you actually preparing for the consequences when it does? It's easy to measure the odds. It's much harder and much more important to be ready for the outcome.